Awesome. So the first thing I would love to always, it's a way of asking, just, how did you get involved in multifamily?
Yeah, that's a good question. It was actually kind of accidental because so I come from a real estate family. My parents are successful real estate investors. And really, I mean, my mom is a successful real estate investor, and my dad just supported her business. And as like an adult, I have a degree. I know all the things there are to know, because I was 20. And so I said I was going to go and do something totally revolutionary. And so I went into corporate real estate and worked for some of the biggest companies in the world. I left in 2012 to start investing for our own family, like my husband and I's family. And I started getting requests from friends around me. Can you teach me how to do this on the weekend? And no, because I do this 100 hours a week. There's no time on the weekends to do this. And so then it became, okay, well, wherever you guys are investing, why don't you let me invest with you? I'll write you a check. And so that was the first time I ever really thought about taking investor capital, retail capital. And so I reached out to the securities attorney that I'd worked with in my corporate life. And ultimately, he got everything set up for us. We still use him to this day. And that's how we really got started and were able to get to scale, because with multifamily, it's sometimes harder to get to scale if you don't have capital sources. And so that really was a catalyst into being able to scale up.
So, it's a good point you bring up. Obviously, somebody may have time, somebody may have capital, somebody may have underwriting experience. So did you look to partner up as you started your journey?
I did. I still partner up to this day because one, it's more fun. It's kind of boring to do everything all by yourself and never have anyone to, celebrate wins or cry over stressors with. So I think having good partners are key. I've learned a lot from all the different partnerships that I've had over my career. And I feel like now the older I get, the less I'm sure I know. So I feel like it'll just continue to evolve, and I'll continue to grow as, we make mistakes or, do things right. And we'll kind of try to improve all the time.
Fantastic. And tell us a little bit about like the markets that you invest in, and where you are in your location.
Yeah. So I'm located in Dallas, just north of Dallas in Frisco. We try to invest in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona. I say try because right now we cannot get a single deal. Last year we did 2 deals. The year before that we did 1. Those all happened to be in the Atlanta MSA. I have been desperately trying to get a deal in North Carolina for 18 months now with no success. There was an asset we were bidding on. I still remember it clearly because we wanted it so badly. It was $120 million is what it ended up trading for. And the whisper on it was 110. And we were able to underwrite it. We got up to like I think we ended up at like 118 or 119. And then it sold for 120. And so it's, the one that got away.
Wow. So, all right. So that makes probably everyone in this room feel good when they're seeing and underwriting a lot of deals that just are not penciling out.
Yeah, they're not.
And yet they still go.
Yeah, we've been looking at, I'd say now we look at maybe 400 deals, maybe even more before we see one. Wow. So it's really tough right now.
When you say we, I guess, and that kind of volume of deals, what's your process and system?
Yeah, so we have a team of underwriters. So generally speaking, we'll look at all of the deals that kind of fit our initial buy box out of the gate. So our buy box is the states I mentioned. It's 200 plus units with a heavy preference toward 300 and up. We look for Class B assets with some component of value add. Typically, we were looking at 1980s and newer, but right now pricing on like 90s and early 2000s vintage is about the same. So there hasn't been a really great reason for us to bid as strongly on 80s, but that's kind of our bread and butter wheelhouse. We look for that value add component. We're very boring investors. We're very vanilla. We do the same thing over and over and over. And, it's just a stabilized asset. We also do look for a certain deal size. So we want to see deals that are trading somewhere, like we prefer to be like between 75 million to 150 million, maybe.
And so with the team, is every, or how, like,
I don't know if that's my internet connection or his. You froze for a minute.
Oh, could be my internet connection. Hopefully that's a little bit better. I guess give a little bit of background on the team. Are these like, do you have solid roles or employees, or is it like, hey, if you go out and find me a deal, we can partner up?
No, so we typically don't actually co-GP a deal. So if we were to have somebody bring a deal to us that was, truly off market, typically, we'll pay a finder's fee, and it depends, right? If the deal's really great and we really want it, like we may give up some equity. We haven't to date, but generally because equity is so expensive. So to answer your other question about underwriters, so we have one underwriter that's in-house, and he's employed. My JV partner keeps him on her payroll, but he underwrites all of our deals initially. I actually just interviewed, and I just made an offer today to another underwriter to help with some other modeling that I want to do. I want to get a little bit more in the weeds. So it's not something that we really need to have the person who's already modeling for us do. So I'm bringing on another person. I just made the offer today, and I think he's going to accept it. So we'll have, two different people that are looking at deals, and he's really going to be somebody that develops a model around what I'm looking for as like a quick back of the envelope, and then also like a more intricate model too. So he's going to kind of be the bookends to the main underwriting.
Awesome. So I guess in terms of the size of deal you're looking at, these are larger deals, right? So, are you sourcing them through brokers? What's the business plan for finding the deals?
Yeah, right now, I mean, there's not a whole lot of deals that are transacting off market. There's very, very few. We definitely prefer to look at deals off market, but we're just not seeing that many. So everything right now is typically listed. And a lot of times we're seeing a pocket listing. So it's listed with a broker, but it's not going full market. So we'll see those as a group of maybe like 4 or 5 groups that get to bid on them.
My connection is bad. I'm sorry.
I know. I was just going to say, you went dark. You're a shadow now.
Yeah. I'm going to go on. I'm going to take myself off screen for just a minute, and then it'll come back. So, obviously the topic of today is negotiation and multifamily underwriting tips. So, I guess give us a little bit of, like to unpack how the underwriting goes, what kind of metrics you're looking at. And then if you submit an LOI and you get a response, like go into the negotiation process.
Yeah. So when we submit an LOI, typically we'll get into the best and final round. So we'll get an opportunity to really sharpen our pencils toward the asset, make, our assumptions a little bit cleaner. As far as what we're looking for on underwriting, I think it's very asset dependent. It's hard to just give like a blanket rule. When I'm investing as an LP, I look at what the assumptions are from the seller's T12 or in the year 1 pro forma. So I want to know, are you assuming that you're going to run payroll at $1,000 a door? Because I know that that's likely not realistic in the markets that we operate in. So I'm looking for more of those anomalies from what I know to be true, at least across our portfolio. So I have like a little bit more insight than most investors do, because I can see what our portfolio does. But I'm also looking for the justification behind the business plan. So right now at this point in the market cycle, I really do not invest into anything where the business plan is the assets below market rent. So we're going to just increase rent. It's a great way to add value. I think, you definitely should be doing that when you're operating, but I don't think that that is a business plan, because if it was that easy, why isn't the current owner doing it? Right. And so I like to look for, okay, if we do X, Y, or Z, the result will be ABC. And so that's what I look for. So we naturally model out the same way. I also try to look for assets that are underwritten more conservatively. So I would rather get a lower projection than a higher or more aggressive one and have it miss. And I'd rather be in a much more stabilized asset in today's environment.
Interesting. And then I guess, how do you define, because people have different definitions of, the class B or, value add, like how do you define it?
Yeah. So the assets we're going into are typically class B, B plus assets. Usually anything like 1980s vintage and newer, especially like if it's mid 80s and newer, I would say overall, it's probably a class B asset. The location, it's dependent on what the demographic is. So the locations we've gone into in the last few years have had a very strong tenant base. So they have A ratings across the board for all of their schools. They have a median income in the 1 mile radius of about almost $100,000. So they're very solid, stable tenant bases. And especially now in like a COVID world, we're always looking at the history of what happened during 2020 and 2021, because that really speaks to the strength of the tenant base as well. If you see an asset that has a lot of bad debt or a lot of delinquency, you want to be asking questions. Are their rents too high? Or is this tenant base unable to sustain a lost paycheck? So there's a lot of deep dive that happens from our perspective, especially not even just due diligence, but even in the LOI phase, we do a lot of due diligence because we go hard day one and we're putting up, like our last deal, I think we put up like $2 million out of the gate. And so can't really afford to change my mind once we're in it.
That's great. And do you find right now it's such a competitive market that what going hard with a certain percentage of money is kind of something that's now become the norm?
Oh yeah, absolutely. Like I can't even put an LOI in without hard money day one, with very, very, very narrow exceptions. We have 4 that we typically try to get in at a minimum. And even that will sometimes clear them before PSA if we can, like, for example, survey is one. And so if we can address that there are no material changes to survey, we'll remove that contingency or carve out to the hard money. So usually we're seeing hard money day one, we're seeing more hard money after due diligence. And then we're seeing if you're getting an extension, which on our deals, we are not operating with extensions, but if you're lucky enough to get an extension, usually there's an additional component of hard money that has to go up to buy that extension.
Before I go a little further, I just want to reset the room that anyone that joins, please use the chat, your information, any questions. We're going to open up for questions soon, and it'll become more of an open context. So, you mentioned PSA for, I guess, anybody that may not know exactly PSA. You want to explain a little bit of that and then your process around it?
Yeah. So PSA is just a purchase and sales agreement. So on commercial contracts, we don't use the typical, state promulgated form. We use a contract that's negotiated by attorneys, which can get very expensive, especially if you are trying to get something that's like very seller friendly or very buyer friendly. Usually there's a lot of back and forth. But so typically the process is we put out the LOI. If we get accepted, then we start moving to the PSA negotiations. Typically we try to negotiate PSA within like 7 days is pretty standard. We go back and forth. We maybe turn it back and forth between the attorneys 2-3 times, and then we execute. And once we execute, usually our hard money is due within 2 to 3 days of that.
Okay. So I'll open it up to the group if anybody has any individual questions about what we've talked about so far.
Veena, hi. Thank you so much for going through that. I was just curious, you talked a bit about the current market cycle. We're just curious how your underwriting has evolved if at all? You talked about going up in quality in terms of tenants and things like that, but as far as your assumptions on the underwriting.
Yeah, so taxes and insurance, we have adjusted pretty significantly. I think, one of the things I see often on underwriting when I'm evaluating deals is insurance still at like $300 or $400 a door. Especially given the storms that happened just last year, we're already seeing an increase. Last year, we saw a 30% increase from the year prior. So making sure that that number, even if it's lower or if it's at that 300 or 400, I would say make sure that that is an accurate estimate from your insurance provider. Or, if you have a master policy, sometimes you can decrease that cost. And then as far as our post-renovation assumptions, we've actually brought down the post-renovated premium, and we've adjusted investor expectations pretty significantly. So at this point, we're really targeting deals that will produce we'd like to hit a 6% cash on cash return. Our year one pro forma on the last two assets we've closed were at 4.5% year one, but we were very conservative in underwriting it. So since day one on both of those assets, we've been delivering the 6% with no issues. So those are some of the changes we're making. We also look for an investor net to investor 12 to 15% IRR. If it doesn't meet those metrics, typically we won't make an offer, or we don't offer above what would deliver those returns from our underwriting perspective. I'm trying to think what other changes we've been making. We've been actually seeing a lot of demand for workspaces in our assets. So because our tenant base is very strong, a lot of them do or can work from home. So they're demanding more like little nooks and crannies to be able to work from home when it's not all cramped up in the apartment. We also are seeing much more activity on our amenities than we did before. And again, that's just more of a function of everybody's kind of at home, not doing a lot. And I think too, we've had a big shift. This isn't underwriting specific, but we've had a big shift to more community building from a virtual perspective. So since he dropped off, so he won't even hear me, but he can watch the recording, right? So we've seen definitely some shifts on our underwriting, but I would say that a lot of it is with targeting the assets that we target. And so our return projections are just lower because they're more low risk assets.
Do you, your deals, I guess, do you have like a certain profile of investor and then maybe target a specific deal to them? For instance, like, maybe some people are looking for more cash, or some people looking, to wait, they'll wait 5 or 6, 7 years for a larger return.
Yeah. So I don't target our deals to specific investors. I would say the vast majority of our investors kind of have the same buy box, same criteria. We do a lot of investor education. So we raise a lot of our capital in between our deals. We have to raise $30 million in 42 days because we do 21 days of due diligence, 21 days of close, no extensions. So in order to raise that kind of capital, I have to prepare our investors and have them know and understand ahead of time what they're investing into. And then by the time a deal comes, they're really only vetting the deal itself because they've already vetted me. They've already looked at our company. They've already looked at our track record, done all of their due diligence. So all they're evaluating at that moment is just the OM I'm putting in front of them.
I have a couple of questions.
Yeah.
So one question is, when you said that you were to receive a ratified purchase and sale agreement, and you said that your hard money is due 3 days after that, do you mean like an LOI from a hard money lender, or do you mean like what? Can you specify what you mean by that?
Yeah. So we put up the hard money out of pocket. So
okay. So
it gets wired from our account straight over there.
Okay. So funding is 3 days from a purchase from the gratified contract?
Only this is in like the single family world. This is what you would call earnest money.
Oh, okay.
So we call it hard money because the money goes hard. It's not refundable. So hard just means not refundable.
Okay. And then just out of curiosity, so with the deal sizes that you guys are doing, what kind of leverage do you guys usually get as far as like your financing?
Yeah. So again, very asset dependent because typically, at least right now, we're not constrained by LTV. We're actually constrained by debt service coverage ratios. So typically we're getting to maybe the maximum we would go in general is to 75 in today's market. Of course, that changes as interest rates rise. That's going to change, but 75 is typically the max we would go to. But recently we've been going to like 72.4, around there.
Okay. Yeah. Because with just like a couple of commercial deals that I've had to get LOIs from, I was getting like 65% leverage. And like that, so a lot of people, they weren't going higher than that.
LOIs from who?
Hard money lenders.
Okay, so that's going to be the big difference. So when we are doing our deals, we don't go for hard money. It's too expensive for us. And to your point, they may not lever enough. They may not understand the market. So the big difference between commercial and single family real estate is the way you underwrite a single family deal is underwritten to the comps around you, right? You need to know what the closest assets within a half or mile radius sold within the last 6 months. And that's typically how they assign value on a per square foot basis. And then they make adjustments for whatever finish outs there are, right? On the multifamily side or the commercial side, they don't care about you as a sponsor, whether your credit is good, bad. I mean, they care somewhat because they want to know who the sponsor is, but generally speaking, they're not underwriting and saying, hey, do you have a $100 million net worth that you can buy this deal? So what they're actually doing is they're underwriting the business of the asset. So they're looking at what income the asset can produce. And that's what the debt service coverage ratio is. So for every dollar of income you have, generally you need about $1.35 for every $1.35 of income you have coming in, you can take out $1 of debt.
Okay. Yeah. So like a 30% 130% debt coverage ratio.
Correct.
Okay.
So in the commercial world, we use like a decimal. So it's like 1.35, 1.2, and you can get certain waivers. They are being very, very tight about giving waivers out during COVID, but you can get some waivers, and I've seen it as low as 105 on the debt cover, but that's just not our cup of tea. It's a little bit too leveraged for our investor profile.
Yeah. I'm in the mobile home park space.
Okay.
So the financing
that's different.
Is very, very difficult.
Very difficult.
And I deal with hard money, but there's pretty insane returns when you can get in the mobile home parks. But the problem with it is the financing is very, very, very difficult. I've got four parks, and it's like the first park I had nothing but like like the biggest property I had at that point was a 5-unit, and then just like not mobile homes, just apartment building. And when I was trying to get the financing for it, was impossible. So I brought on a joint venture, and I was like, listen, I'll just take 30% equity. I don't care. I just need the credibility. And once I got that, I was able to get the financing. But still, I mean, it's difficult.
It is hard. Yeah, because for you, banks or lenders, they're very, very conservative, and they see that as a very high risk investment because of the nature of turnover in mobile home parks. For us, we are going after, even within multifamily that's so stabilized, we're going for even more stabilized assets by just nature of what we transact on. And then also the size of the assets we transact on. So the larger the asset, in my experience, the larger the asset, the easier it is to finance. So I financed, we did this deal once. It was, how much did we pay? 3.2 million for 28 units. Oh my gosh, that was the hardest deal I've ever tried to fund, more so than any of my larger deals. And the only reason we bought it is because we owned the property next door. So it just was a nice addition, and we controlled the whole north part of that strip. But the larger the deal, I know it's counterintuitive, but the larger the deal, the easier it is to fund. Yeah,
that's true. I closed a 34 unit last month in December, but it was only for 700,000, and it was a mobile home park.
Wow.
And it was a lot of the lenders, they have like $1 million minimum loan amount for the and that's their loan amount. That's not purchase price. So and they're funding like 65%. So I'm like, oh man. But the financing was difficult, but I was able to get in with, I got 75% leverage on it, but I ended up paying like a 13.99% on a 1-year bridge loan. And it was, it's grossing 180. So my net is a 130 conservatively. So it was a good purchase, but the financing, it was nearly impossible. But now we have a local bank that gave us soft terms at 4% for a 10-year balloon on a 20-year AM. So,
that's great.
Yeah, so we're in the process of doing a cash out refinance now.
Awesome. Congratulations. That's awesome. We do not have the same, our lenders don't play in the same field there, because if they gave me anything today, well, I shouldn't, interest rates are going up. So, but like our last 3 deals, we financed for 2.99%, mostly 3%.
That's really good.
Yeah.
But you have different, your asset is way better than my asset.
Yeah. We have a spread over either the SOFR or LIBOR. Now the standard is the SOFR rate, but it used to be LIBOR. So it's like a spread. And then also in multifamily, especially with like Fannie and Freddie, the more you borrow, the better the rates you get too. So our spread is lower than someone who's, for example, a first-time borrower. So like you said, sometimes you got to pay the piper to get in the door, and then much easier after that.
Awesome. Thank you.
No, thank you.
Question. So Veena, I guess now take us, to we talked about the PSA, the LOI, like now take us to that, your best and final negotiation process. Give us a little bit of color on that.
Yeah. So on best and final, so anytime we submit our LOI, when we initially submit it, we submit it with room to go up. So we want to submit high enough that we get invited into the best and final, but we want it to be low enough that it's not our highest number. And a secret is there's also a secret best and final round that they don't tell you about. So always in your best and final round, leave like just a teeny bit more. So maybe like $100,000, $200,000 on like multi-million-dollar deals. So we go into our best and final, we really do sharpen our pencils. That's when we're doing a lot of our due diligence. So upfront, we do about 90%, 95% of our due diligence. And then during the due diligence process, it's really just confirming what we believe to be true versus anything else. We will have had any structural engineers or contractors or anything that we need to make good decisions, or we need to make finalized decisions on, especially if it'll affect the underwriting significantly. We do that out of the gate. We also get our property manager, we get them involved very early on, and we want to have their buy-in from the budget perspective, because ultimately, if they say yes to a budget, then we force them to basically stay on track. We hold them accountable, because if they can't produce on it, then they need to tell us before we enter the LOI phase. So we negotiate PSA. Maybe we get awarded the deal. Mostly we don't. So it's, just a little sad phone call from the broker telling us we did not win the deal, telling us someone paid like $1 billion more for every asset. And then but if we do get the asset, we immediately start triggering like multiple avenues. So we start triggering our COIs for insurance. We start triggering our our PPM for our investors. We start working through the PSA. We start working on insurance. We start getting our lending in place. So everything all kind of like starts in the same 48-hour timeframe, 24 hours if we can, just so that we're basically ready to go. After that, we just kind of move through the process. We stay on track with what the PSA says once it's finalized. But the PSA negotiation can sometimes take a while.
So again, just to reset, use that chat. Remember to use the 3 little dots on the right so you can save down information into your computer. It's great. You want to contact with everybody. Before I move on, anybody else have any other questions for Veena before we...
Yeah, I have a question. Veena, thanks for your time.
Of course.
As the 10-year yield goes higher, the interest rates goes higher, and the rent growth reduces, what do you expect on the asset evaluation? Do you think you'll be able to meet the investor expectations when you try to sell the properties after 5 years? Especially in Texas, the rent growth have been 11%, 15%.
Wow.
That's not going to sustain, right? Somewhere, at some point in time, it kind of cools off. Here, in a lot of the deals I see, they give 8% cash on cash, and then 2x multiple. Of course, they kind of go on Class C nowadays. All those cap rates have compressed. Classes. So we've been investing a lot of money now as a limited partner. But what do you see in the next 5 years with all these, interest rates going high and a recession coming in, that we read on CNBC and whatnot.
Yeah. If you would have asked me 2 years ago, my answer would have also been the same, that I think we're at the top of a market. But clearly I was wrong. I did not think cap rates could compress any further. So what do I really know about the future? What I can say is we have already adjusted investor expectations. I do not remember the last time I saw a deal underwrite for a 2x multiplier over 5 years. It's just not happening in the space that we're in. If you're getting that on your underwriting, you missed something or you made a mistake somewhere. There's an extra zero or there's an issue. So go back and look for it. I also don't remember the last time I saw investor returns at like 17, 18, 19, 20% on the IRR. It's been years. So our projects we put out were historically in the last, or I should say historically after COVID, right? We have been looking at deals that are typically coming out somewhere in the 12 to 15% IRR range. Now, from a cash on cash perspective, our deals are value add. So in the first 2 years, we're really repositioning the asset. We're optimizing efficiency. We're pushing rents. So our deals typically will not underwrite to an 8% cash on cash. Now, one thing I've noticed, especially recently, is investors are getting confused between cash on cash and pref. So the preferred return can be 8%, but you may not hit that in the first year. For us, we put out a 6% pref on our Class B shares. And even though our deals have been underwriting to 4.5% cash on cash, because we were conservative, we're able to actually deliver the full pref from day one. So we're delivering 33% above expectations. That's very important to us. And to answer your question about whether I think we'll be able to deliver on investor return expectations, I do, because I think we set really realistic expectations. I do think that cap rates will expand. Maybe they'll compress a little bit more, but I think that in the next 5 years, I mean, I don't know how much further they can go down, but I'm probably going to be like eating these words next year when we talk again. But yeah, I do think cap rates are going to expand. I think that it's key to underwriting right now to underwrite to a cap rate expansion assumption. There was a time not that long ago where we underwrote to the same cap going in and out, or even a lower cap on the exit. That was not considered that crazy 5-6 years ago. But today, absolutely not. We increase at least 7 to 10 basis points per planned year of hold is kind of the rule of thumb. That's like a fairly conservative assumption, especially in our markets. We also look at what historically has happened in our markets and how quickly the cap rate expands. I'll give you an example. It's all about being conservative and being able to actually deliver on the assumptions that you're making. So if you don't know if you can get $500 a unit, then maybe assume $200 that you're confident you can get and be really happy when you get 500. So we bought an asset in October of 2020 in Atlanta. It was 494 units. We bought it for $80 million, and it was mid-COVID. So that was like a whole different beast to take down, but we closed on it. We had a 5-year projection. We projected at 15% IRR, and we had a 7 and 9% pref, 9% for Class A with no upside, and 7% for Class B with a 70-30 split. We are now, we're actually literally in the middle of negotiating an exit on that deal. And we have already hit year 5 pro forma. We will likely be, and I don't know exactly how high, I'm waiting for the best and final LOIs to come in. So I don't know exactly how much it'll be, but with the offers we've already got on the table, we are going to be at like a 60% IRR, 58.48% IRR, and a 1.9x multiplier. So I've almost doubled investor money in 18 months.
Wow. Yeah. I've heard some stories like that.
Yeah. I mean, that's just a sign of the market that it's some amount of value add. But it's significantly impacted by the cap rate compression. We went in at almost a 5 cap. It was like 4.7 cap. And now we're trading it at like a 3.5, I think. Right. So yeah, that's definitely not hurt us. Also, too, what I'll say is we underwrote it to a -7% NOI from the seller's T12. So we said we only have to operate at 93% of what the seller's doing to deliver these returns. Right. And from August 2020's T12 to August 2021's T12, we actually saw a 15.8% increase on the NOI. So it definitely was a function of underwriting conservatively, operating it really efficiently, but then also the cap rate compression. I don't mind.
Yeah. Thank you. Appreciate it.
Of course.
So in terms of
when you talked about the property management, you said that you negotiated a budget. So is that like a you give them like a salary?
Oh, I'm glad you're clarifying that, because I say negotiated because it feels like a negotiation. So basically, we ask them to put together a budget for us on what they think they can do in terms of what's the market analysis from their perspective, because they manage 40, 50,000 doors. They have a much better database than even we do, right? So what they do is they'll tell us how much they think we can get for rent post-renovated or not unrenovated, how long it'll take to lease up, what the occupancy expectation is, what the pricing assumptions should be on each of the line items on the T12. And then we go back and we'll be like, okay, but we want to do this. Is it possible? And they'll be like, that's not really possible. Or we'll kind of like negotiate what the finalized budget will be. Not a true negotiation. We just kind of have a lot of back and forth and discussion points around it.
That's good information. I never thought about talking to property managers in the area about getting more due diligence on a property.
You definitely should. And you should too, because if you have a relationship with one of them, when they're exiting, they know that their sponsor or their owner is exiting an asset, they'll call you and tell you about it.
Cool. Sounds good.
Yeah, definitely. Those relationships are important.
All right. Thank you.
Absolutely.
I have a question about those value adds you've been mentioning. What do y'all typically have what you expect because your asset class is so rigid, or is it kind of like you get into the property and you're kind of deciding on the point, like, well, we think this property can be improved with these typical things, or do you see a trend?
Is your question about how we decide that there's a value add component?
Yeah. So like, how do you decide the value add component? And then do you typically see a trend in the type of asset you're going with?
What do you mean by a trend? A trend of what?
So is it typically like it's a 1980 product? There needs to be a new paint, new carpet. We want to move to laminate vinyl flooring, or is it like each property is unique in its value?
Okay. Yep. I understand. So when we look at our assets, we know which units are classic or which are upgraded. Typically, if you're in like an 80s or 90s vintage, usually there's some amount of value add already completed. But I think that's part of, the secret sauce that you can develop for your own team, because what we do is I'm going to tell you our secret sauce. So we go in and we market shop. So we actually confirm all due diligence we get. So we don't just pull Axio or CoStar and go with those numbers. We do initially, but then we actually comp shop. So when we're comp shopping, we're looking to see, okay, are they putting granite? Is that what the market here calls for? I'm exiting another asset here in Dallas, and I heard inadvertently, I ended up on a call where the buyer was raising capital, and I did not realize that was going to happen. So it's kind of weird for me to be there as, being on the sell side. But one of the parts of the business plan was to put granite in. And, that is not something I would do in that specific asset, because I don't think the market calls for it. So it's very much property specific. Generally speaking, though, you're going to put in, your hardwood, you're going to put in your stainless steel, probably granite. Washer and dryers are a big value add component. Parking is huge. I think that a lot of people overlook the power of parking, especially just reserve parking, because it's paint and a stencil. It is very cheap to implement. And if you reserve the spots in front of like right where the doors are, right? Like your stairways and stuff. If you reserve those spots in front, there's multiple things you can do with that. One, you can see if someone will pay you 10, 15 bucks for that. Two, you're making it inconvenient for the people that happen to get there earlier. So they may end up paying for that convenience. And three, it's a great tool to use if we are in a concessionary environment. We're not right now, but when we are, hey, your lease will get you 6 months of free parking. And what we find is, one, there's no expense against that. So it's really not a huge hit to your T12. But two, once they've had 3 or 6 months of parking, they've gotten used to parking there, they're much more likely to go in and pay an extra 10, 15, 20 bucks for parking. So to answer your question, it depends completely on the asset. Oh, Amazon lockers. Those are another big one that I feel like it's weird that we've bought a couple communities recently that don't have them, especially for the type of tenant we have. But package lockers, that's easily the #1 request from most of our tenants if they aren't already on the property.
By Amazon locker, you mean like lockers for deliveries that they can fob into?
Yeah, I say Amazon lockers. You know, Jeff Bezos should really pay me, but he doesn't. I pay him a lot because I order like every 2 seconds from Amazon Prime. But yeah, package lockers or parcel lockers. So there's like a bunch of services. There's like Fetch. You know, Amazon's probably one of the biggest, shockingly, I know, but yeah, I think that those are very, very useful. You can charge an income on it. You know, in lower rent areas, you might see like $7 per month per tenant. On our assets, you might see $25, $30 per unit per asset. Same with valet trash. You know, that's another one that we see a opportunity a lot of times for our tenants to, one, have the convenience, two, keep our asset cleaner, and three, generate income.
Another question I had is when you're talking to investors, or not really talking to them, what type of structure do you have for your investors? I'm still fairly new to this. So like, is it when it comes to like the payout, are you splitting the cash return on them, or is it just equity? Like, how does that work?
Yeah, so it is equity. So that means they have actual ownership in the asset. It's not debt. They don't have a recorded lien against the property. So with that, we typically structure the same way every time. So we have an A class and a B class of shares. Our class A shares, we typically are doing an 8% preferred return and no upside. So that means that the first 8% of cash flow from the property goes entirely to class A investors, and we don't get to share in that cash flow. The class B shares get 6%, but they also share in the upside. So that means that the first 6% of cash flow goes to the class B investors. And then above and beyond that, the LPs or the limited partners take 70% and we get 30%. We have a secondary hurdle. So it's called like a waterfall. So our secondary hurdle is typically an IRR trigger. It can be any KPI that you want. I mean, you have a lot of latitude to set how you want, but investors may or may not invest if it's unreasonable. So we typically will set it at, 12, 13, 14, 15% IRR. And then we go to a 50-50 split after that. So it really aligns all of our interests, because the better we perform, the more we get paid. If we don't perform or if we underperform, then the investor is protected because they're taking the first preferred return. Does that make sense?
Yeah. And is that on like monthly cash flow as well?
Oh, yep. Yeah. So the 70-30 split is on monthly cash flow, but I will tell you, on our assets, it's very, very, very rare that we see any additional cash flow above and beyond the preferred return. I mean, even getting to the preferred return is noteworthy in the types of assets we're in. Usually we see that split really kick in either at some kind of capital event. So either a supplemental, a refinance, or an exit.
And I assume like in the expenses, you're calculating like your operating costs for like finding the next deal and things like that.
No, so we don't commingle our deals. So there's never, if you're in deal A, you're never going to be exposed to deal B unless you invested into deal B. So the cash flow, expenses, all of that stay completely individual on each deal. If you're looking at doing it where you have all the deals kind of merged together, you're really looking for more of like a fund or a REIT structure. Make sense?
Yes. Thank you so much. I appreciate it.
Absolutely.
Question for you, Veena. I'm sorry, earlier you answered my question very well, but I got booted, unfortunately. So
I saw that. We decided you'd watch the recording later.
Apologies, tech issues.
No worries.
Yeah. So was wondering about your assets. Are they mostly in your same Dallas MSA? You might have covered this, but if you have any assets that are, you mentioned, I think Atlanta, and are out of state, how often do you visit the assets? Personally, I guess.
Yeah. So somebody from our team, so whether it's the asset manager or, my JV partner or myself, I would say we're out there maybe at least once every other month. Initially, we're there pretty often. Usually I go out and I spend a week at the property during due diligence, and then I spend a week at the property post-close. And that's like in my initial acquisition, but then, we'll visit often. Now in Atlanta, it's a lot easier because my sister's actually a partner in Vive, and she lives like 10 minutes away from our most recent acquisition. So she's there like every week. And, she can always go and check out any of the assets. We especially get on planes if we see any deviation or any trend that we don't like. We get on planes and get out there. But between the team, I'd say at least once a month, once every other month, we always have someone going to the assets.
Sounds like I've got to get sisters or something like that in the local market.
Yeah. And especially if you can get sisters that live really close to your asset, that's even better.
I'll talk to my family.
There you go. Yeah. Complain to your parents.
So we're this was awesome, and it just goes by so fluid and quickly when we're having a great discussion. So we have a few minutes left. I do want to get you right before you talking about negotiation, like give us like whether it's a horror story or the craziest story that you have of negotiating.
You said we only have a few minutes left?
You can take it, it's up to you.
Oh my gosh. Let's see, which one to share? I'm trying to think. I have so many. Okay, actually, my most recent negotiation, where I am the seller in the hottest market we've been in our entire lifetime. The buyer that we just ultimately decided to go with, and I don't know this buyer, so I had no idea what to expect. I kept asking the broker, I'm like, are you sure they can transact? And these are smaller deals we're exiting. These are like $20 million deals, isn't like a $100 million deal. They submitted an LOI. Their LOI said hard money day one, no exceptions, like no carve outs were indicated in there. So, naturally we go based off of the LOI for the things that are in there. And then everything else we kind of, talk back and forth, negotiate. I spent 6 weeks negotiating this back and forth because, and it was very clever. So I admire that. But what he kept doing was he kept inserting reps and warranties into the seller reps and warranties section, which means that if any of those are not true, then we are in seller default, which is one of their carve outs. And I kept saying, we're not going to rep to that. We're not going to, like, I don't know how many times we said that. And this is a particularly interesting one. And it's really something that is like a woman faces this problem, but he would call me and he would explain to me how due diligence works and how underwriting works. And he would explain these like really basic things that anybody who's transacted on multiple deals would know. And he was like, well, how can we buy an asset if we don't have all of your insurance loss runs? It's just, that's not practical. It's not possible to do a deal like that. And, this is how it works. And this is why we need it. And I was like, okay, I closed on more deals last quarter than you've closed on in your entire last 4 years or whatever. He told me like, I've closed on this many deals in this many months. So anyway, I was like, okay, well, we've closed on deals without loss runs and we didn't have a problem. And we closed in or ahead of schedule. I think that one we had closed in like 57 days. And but it wasn't just that. It was like everything I said no to, he would come back and explain to me. And I was like, I'm not as dumb as you think I am, but also you didn't tell us you wanted all these things in your LOI. And so we just aren't going to agree to them. Finally, it got to the point where and you have to remember, these are super expensive attorneys. Like they're charging us like $700 an hour to negotiate this. And on a deal that size, it's so astronomical to pay tens of thousands of dollars on something as ridiculous as this. So I finally went to him and I was like, listen, we're not negotiating anymore. We're done negotiating. I've done everything I'm even possibly going to do. and it's up to you to decide if you want to take it or leave it. And he's like, well, we're so close. I'm like, great. Then it sounds like you have a decision to make, because I'm not doing this anymore. We'll keep the asset. It's doing really well. We'll continue operating it. We don't need to sell it. So I said, I'm going to give you 15 minutes. And after that, do not call me back. Do not text me. We're done. And so 10 minutes later, I had a signed contract. And then I had a phone call from him, which I didn't answer. I missed his call, whatever. And he was like, I was just calling to let you know, I signed the contract in the last 10 or within 10 minutes, not 15. I was like, great. You spent 6 weeks negotiating a contract that should have taken less than a week to do. But that was definitely one of my most challenging and frustrating negotiations, I will say.
That's an awesome story. So definitely push you to the limits there, but
I mean, I can't even tell you, I was tearing my hair out. I was so mad. But the funny part is he also wanted to transact on $100 million deal we had. And it was like, maybe no. So being an easy buyer to work with is very important for reputation.
Absolutely. Well, Veena, this was awesome. I appreciate you taking the time Thursday. This was great. And what we do a networking breakout rooms after that. Obviously, do not have to stick around for that, but I appreciate having you. If you want to give us any final words, I dropped in the chat how to reach you, your website, LinkedIn.
Yep. No, I appreciate it. Thank you for having me. I like the Carolinas. I hope to transact there this year. Let's see. I think that just from a scale perspective, if you are looking to scale up, I wish I had known how much having systems and processes made it easier from the jump. It's always hard to invest into a business with hard dollars when you're not generating as much income. And it would have made it so much easier for me to scale so much faster, maintain your reputation, because that I think is, the scarlet letter. If you get a bad reputation with brokers, they will not let you transact in their market. So build those relationships, pay attention to them. And right now the market's tight for everybody. Be disciplined. Don't overpay for assets. Just patience is a virtue for a reason. And I think we're seeing that exercise right now in real time. So those are kind of the things I would say.